Who wants to hear about a couple of awesome investment opportunities from some awesome people? Cool. So what I'll ask everybody to do now is just hit your mute button, except for John, because we're going to go straight. We're going to go gentlemen first tonight. So
Yeah,
we're going
if-
to ask. Yeah,
if-
we're going to
if-
ask John Manley from MakeSpace Capital. He's a business development manager with MakeSpace. And MakeSpace, how many people have been on one of the MakeSpace presentations that we've done before? Probably Allison has, I think. But I think a lot of the rest of you are quite new. So this might be hearing this for the first time. So really excited to hear that MakeSpace is growing, doing well. And you're ready to take in more investment and expand more. And just kind of a happy coincidence, all of you know Joan Probert. You've seen her RV story and her getting ready to move to Victoria. And hopefully you've seen the latest WREN video that we put together with some highlights from the last couple months, and Joan talking about by 5 o'clock, it was mine. So Joan booked a MakeSpace container on the weekend. And so I helped her load it up. We got that. Man, did I, by the way, I am the Tetris queen. I'm not gonna like I people have told me I'm the Tetris queen. We managed to fit basically the equivalent of a 4-bedroom house in the container, and we still had space left over.
That's amazing.
Yeah,
That's
it
amazing.
was it held a lot. 20 by 8 by 8, is that right, John?
Yes, and yeah, just happy to help her through those logistics. I could tell in her email she was getting nervous, but we got it done.
Got it done. Yep. So that's awesome. So John is has a great background. He's 20 years in capital management, 20 years project manager, and now he's with MakeSpace. And I'm going to turn it over to John. Now, just so that you can also make the connection, MakeSpace works with one of our favorite people, Lynn Trevison from Raintree Financial. So Lynn's not able to be here tonight. So we're skipping over Lynn and we're going straight to John. But if you do have questions, basically what we do is we go through Lynn, and she helps you get invested into MakeSpace. So John, I'm going to just make sure you have the power, and
Yeah,
then you can
share again.
take it away and show us some MakeSpace.
All right. Can everybody see that okay?
Yeah, it looks great.
Beautiful. Okay. Liza, thank you very, very much for inviting me here tonight. Really appreciate being able to present to real estate folk, because you guys are really going to understand this. If you understand real estate syndication and packaging and that sort of thing, I think this will fall right into your ballpark. But yes, and Lynn was supposed to be here tonight. She couldn't be here tonight, but if there is any interest, it has to go through Lynn. We can't solicit directly to the public with our registration. So it would have to go through a Raintree advisor, but Lynn can certainly give you all the information that you would need to know to make sure this is a good decision for you, or the right decision for you. So as Liza said, yes, 20 years in the capital markets. I was a portfolio manager in the public markets for about 17 years. I got very interested in the private equity space about 3 years ago, and connected with the great people at MakeSpace Capital Partners. They told me what they were trying to do. I thought it was a wonderful project. So I'm going to sort of give you sort of an abridged version tonight. I'm going to give you all the sort of the key points, so you can have a pretty good high-level overview of what it's all about. And if there is, more deeper questions later on, we can sort of find a way to connect and get those answered for you. But yeah, it's MakeSpace Capital Partners, and just a quick disclaimer here, just to let you know that we can't present all the information that you need to know tonight in this little short presentation to make an educated decision on whether this is the right investment for you. And that's why we have Lynn in the picture, and she can certainly help you with any information that you may need. All right, so what are we going to talk about tonight? What are you going to learn? What's the sort of the key takeaway? Number one is, why self-storage? And again, I know you're all real estate people, so you got lots of choices between, multifamily, mobile home parks, office, industrial, that sort of thing. So why should you even look at the self-storage industry? So I'm going to sort of give you some insights on that. And then number two is, why us? Why MakeSpace Capital Partners? How do we stand out in the self-storage space industry? So we'll highlight a couple of key points there. And then number three is, why now? Why should you sort of look at this now? And one of the key factors that we're sort of looking at is this era of zero bound interest rates that we're in now. And we know that investors are hungry for yield. I mean, you guys know that. You're all in real estate. You're in commercial properties that throw off cash flow. They throw off yield for yourself, for your investors. It's a really nice place to be in an ultra low interest rate environment where GICs, depending on the term, are paying 0.5%. And some folks don't have a choice. They need that yield for their yearly and quarterly living expenses. So yield is very important. So what is the MakeSpace Capital Partners Fund? So what it is it's a private self-storage fund, and it's open to retail, accredited, and institutional investors. And what we're doing is we're building a portfolio of about 15 to 20 stabilized self-storage cash flowing properties across Canada. You guys all know those terms, stabilized, what that means. It means that there's a net income there that perhaps supports your splits and distributions, and everybody's happy and they're hoping for some capital appreciation on the back end. So we're also a fund that is currently paying our targeted 6% annual distribution to our investors. That goes out quarterly, and that can be taken either in cash or a DRIP program, a dividend reinvestment program. And then we're looking for capital appreciation for our investors on exit, which we'll talk about is midsummer 2025. All right, so how do we get started with all this? So as you guys know, that any business, has to solve a problem for somebody. If we don't make life better for somebody else, then we're really not doing anything special. So what was the problems that we were trying to solve in the self-storage space? Well, number one is supply and demand. And this is key to any business, doesn't matter whether it's self-storage or multifamily or any kind of business. And what we sort of found out with our research in Canada, as far as supply, there's about 2.5 square feet of storage space available per capita in Canada, which is a rapidly growing country, whereas the estimated demand is north of 4 square feet per capita. So that in itself presents an opportunity. So this is kind of the basis of where we're starting from. Number two problem we're sort of looking to solve, and it's really not a problem, but more of an opportunity, is that the self-storage space in Canada is fragmented, and that simply means that it's owned by individual operators. It's not owned by institutional syndicates that are professional operators. And that sort of lends the opportunity to consolidate and build a portfolio and establish operational efficiencies and expense ratio efficiencies and package it up. And what we found in Canada with, there is one very large self-storage REIT called Storage Vault. Wonderful company. They'd like to gobble up all the self-storage in Canada. But what we found in some of the acquisitions that they've made is that on a portfolio basis, the portfolio is worth much more than the sum of its individual parts. When somebody comes along, builds that portfolio, they've done all the heavy lifting, they've branded it, they've institutionalized it and standardized the operations. So it's sort of just a handoff to a larger operator, and they can just take advantage of that cash flow going forward. So that's kind of what we're doing, is we're consolidating and building up. Now there's about 3,000 storage facilities in Canada. We're not looking to boil the ocean, as they say. We're looking to build in this initial fund about 15 to 20 storage locations across Canada. And we're well along that curve. And then number three is that investors were kind of shut out. It's not like multifamily where there's just a ton of opportunities for passive investing. There wasn't really a lot in Canada. There's a couple more now. There's a couple of competitors in there now. So we're giving investors the opportunity that want to participate in the self-storage space, the ability to do that in a passive way. They don't have to go out and buy the land or buy a facility and operate it. They can sit back and let us do the work, let us operate it, collect those dividends, and then garner some capital appreciation on exit. So with the problem, I'm just going to move this out of the way a little bit. What's the solution? What do we bring to the table? So as we sort of talked about, we're building this portfolio of 15 to 20 stabilized storage investments across Canada. With that, we're building our brand around that and driving those operational efficiencies. We've got a wonderful in-house property management company, marketing company. We have real-time metrics that allows us, from a marketing standpoint, from a property management standpoint, to really, zig and zag as supply and demand issues shift in the marketplace. And you guys all know that, operating a commercial real estate investment, operations is key, right? Keep those expenses low, find ways to increase revenue. And that's exactly what we're doing. And then investors can take advantage of those immediate cash flows. So as soon as an investor signs on, they're in the next rotation for our quarterly dividend. It's not like a development project where you may have to wait, 24 to 36 months. There's nothing wrong with that either. It's just a different style. And, at the end of the day, maybe the returns are kind of going to be the same. We have a certain targeted double-digit return for our investors. And of course, number 3 is that capital appreciation and exit. And we'll sort of look at the business model and sort of talk about what sort of returns that we've modeled for our investors on exit. But, just naturally over time, with the pay down of your mortgages, you got that principal appreciation. And then hopefully, cap rate suppression, just driving that top line growth. And I'm going to talk a bit about now how MakeSpace kind of really stands out of that. But before we get to that, I just wanted to highlight, how has self-storage performed over the long term? And this was a great chart put out by NAREIT. Now this goes from 1994 to 2017, but what it shows is that self-storage in the commercial real estate space over a long period of time through different market cycles, different inflation cycles, has been the best performing asset in commercial real estate, hands down. Not only has it been the best performing asset there, it's been the best performing asset in the public markets also, against the stock market and the bond market. And I think what's really key is where it sits on the volatility curve, because volatility of returns is something that's very important also. So when you have that stability in cash flows through different market cycles, it's going to show up in your volatility of returns. So there are asset classes where, you might have to be forced to get out at a bad time, when it's perhaps under stress or something, and take a bit of a hit because of that. But self-storage has been very, very consistent in its performance over a long period of time. I just kind of wanted to update a little bit here. Here's, the performance from 2015 to 2020. But what's very interesting is that, again, in 2020, we all know that was a very difficult year. Still, the best performing REIT in 2020 with a 12.91% return. So it continues to shine and really live up to that promise of being recession resistant. And that's one of the things that we used to talk about before a recession hit in 2020, is that we kind of looked back to 2008 and said, well, how did self-storage do there? And again, it was the top performing asset. And, the whole pandemic hit, we're a little nervous like everybody else was, like what's going to happen? But we've actually seen business increase because everybody kind of shut down. They weren't moving stuff out of their storages. And actually we saw more move-ins because unfortunately a lot of businesses had to kind of, shutter themselves. So they're moving equipment into self-storage. Kids were not going to school. They're moving their dorm stuff in there. So we'd love to see the economy get back to full speed, but we were just glad we were there to be able to help people out. And, Liza was telling me earlier about her good friend Joan trying to get storage facilities and not being able to. These places had waiting lines, so still strong demand for self-storage. So what's going to drive self-storage going forward? And again, it's the same with multifamily and other assets. It's that population growth. And Canada, as you know, we're a young country, only about 37 million people as of 2018, but projected to grow to about 55 million by 2068. So, just a kind of a nice medium growth curve. And that population growth will drive continued demand for self-storage across Canada. And as you all know, the big sort of targeted centers are Southern Ontario and BC, mainland, Vancouver, that area. So as new immigrants come to Canada, that's where most of them are going. And as you know, Canada has a very favorable immigration policy. We've had about 331,000 new folks coming to our country each year. That's like a medium-sized city being born each year. Now, having said that, we know that through the pandemic, things have, come to a halt for a little bit, but we're anticipating that immigration will crank up again, and Canada has a long runway ahead of it. And this is, again, why we love self-storage, is that our feeling is we're kind of in the second inning of this ball game, and it's got a long runway ahead, plenty of opportunity for growth, and we want to be part of that picture. And this kind of an interesting stat just came out recently. Of the top 10 countries of where people want to live and work, Canada for 2020 came out #1. So we're #1. So it's kind of a nice little stat to see. So we're a popular destination for folks around the world, and I think that will continue. All right, as promised, let's take a quick look at the business model. I just want to kind of recap what we talked about. So we're building that stabilized portfolio, storage investments, throwing out that 6% annual yield, going directly to investors, eventually a portfolio sale. Our modeling is targeting, a 12 to 15%, and we sort of have a median targeted return in there, but just, to give a little bit of leeway, total targeted annual return to our investors. So a nice, healthy double-digit return. And again, I know you guys are all shooting for that in the commercial real estate space also, and it's all attainable. But let's take a quick look at our business model, kind of what makes us stand out. So as you all know, with self-storage, you're all familiar with those big buildings you see along the side of highways with the storage lockers, and that's a wonderful business. The thing is with that business is once those storage lockers get filled, it kind of caps the revenue. We can't incrementally raise revenue over time by raising rents, much like you do in multifamily. But MakeSpace, what it can do because of the experience of our co-founders in portable and flex storage, is bolt on these two other revenue streams, which is portable storage, which is those big containers, which Liza's good friend just leased from us for moving. They can park in your driveway, or whether it's a commercial business, we can just leave it there, or we can bring it back to our facility, stack them up there. It doesn't cost us any more to stack those on our land. But what it does, it takes a ceiling off the revenue and increases the NOI. So we're not just fixed to our doors, the amount of doors we have. We have this flexible business happening on top of the fixed door business. And flex storage is simply really short-term on-demand business. And we have a very vibrant tire storage business where we're sort of doing the back end for a lot of dealers, and we're storing tires. And again, it's a very simple business. It gets changed over twice a year, once in the fall, once in the spring. And in the meantime, our facilities are collecting those rents every month to store these tires for the dealerships. So having those two bolt-ons really, really take the lid off our revenue streams. So how are we going to continue to grow this business? And just as, I guess, a quick overview, we're about halfway through now. So we started this business a couple of years ago, and we're looking to raise $30 million, and I'll talk a bit about that as we go through it. We're up to about 16 million so far, seeing a very large jump in momentum in investor interest, not even just from the retail side, but from the institutional side too. And that's really happening in Canada and the United States. Institutional investors are really perking up and going, you know what, this is an area that we want to be in. So how are we going to grow this portfolio? So number one is, acquisition of new assets. We're very fortunate. Our parent company, MakeSpace Inc., is kind of our development arm. They bring properties into the parent company, they stabilize, and once they're stabilized, they come into the fund. We want to make sure that we can support our distributions to our investors. But now we have projects coming in Kitchener, Ontario, that will come into the fund in 2021. We have a project on Vancouver Island that looks slated to come into the fund. And these are mini portfolios. These aren't single facilities. They're 3+ facilities each. And then we have a new property coming in from Winnipeg coming into the fund in May of this month. That's a stabilized property. So we have a line of sight now to complete the portfolio. I guess it's kind of a long-winded way of what I was trying to say. And then as we just talked about, that expansion of our on-site storage, which is the portable and the flex. And then what's really important is our operational improvements. Having that in-house property management, that in-house marketing really, really helps. And then building the brand. I mean, that's worth money in the bank also. And we've had people say, send me an email or a call, say, hey, John, I saw one of your containers on the road, or I saw one of your facilities, and it makes us feel great that they're recognizing that brand. All right, operations. So as you guys know, again, in commercial real estate, operations are key. So with self-storage, we want to make a really frictionless experience for our customers from beginning to end. So that means automation and booking and billing. So somebody can go onto their app, they can book a site right there. They can come on down to our facility. Everything is contactless. They don't have to touch anything. They don't have to talk to anybody if they don't want to. Check their stuff in, have an automated lock on there. So a really smooth and happy process for our customers. And last year we just integrated a call center, which is great. So now as prospects call, it's not like before where we have an operator, a manager in a facility, and they could be on a forklift in the warehouse somewhere, and somebody calls and he says, hey, I got to call you back. We don't have to deal with that anymore. Now we have that contact center. Somebody calls, they get immediate service. We know where they are in the sales funnel. Same for their customers. We know exactly where they are, what they need to do or have to. So we can respond very, very quickly. And we've seen a huge uptick in business because of that. And then having those real-time metrics on the marketing side, on the move-ins, the move-outs, on rates, so we can move in real time very quickly as demands shift in the marketplace too. So we can zig and zag very, very quickly. And then our in-house property development, as far as our CapEx and expanding the facilities. And we do that also. We've got some development happening at our stabilized properties also, with more square footage being built. So that's all in-house also. And then our in-house marketing, which allows us to react to what marketing is working very well and shift very quickly with that too. All right, so where are we now? 2021 and beyond. So currently the fund's worth about 29 million, 5 properties in there. We do have a stabilized property coming in from Regina. It's going to close in a couple of weeks, so that's going to bring us to 6. And then we have a mini portfolio of properties scheduled to enter the fund mid-2021. And like I said, we saw a huge uptick with our capital raise. Q1, almost $6 million. And we're able to deploy that right away. And even we just sort of did an OM refresh. We just finished our last close, and even with an abbreviated time frame for our last close, we saw another 7 figures come in. So we're seeing a real uptick in momentum of investor interest, and it's a lot of large ticket stuff too, which is delightful to see. So on the growth curve, anticipating the fund to be about 50 million by the end of 2021. That gets us to the 50% mark. We're looking to take this to 100 million by 2025. Looking to complete our capital raise and acquisitions by the end of 2022. And then we're just sort of on the glide path. And the nice thing about that, when we finish the capital raise and the acquisition, a lot of our costs go down, with respect to cost of capital, professional fees. So that's when the NOI is going to really kind of jump and sort of glide us into our planned exit in 2025. Very pleased to add another 5 exempt market dealers to our capital raising distribution network. Raintree is our lead advisor. That's who Lynn works for. She's a terrific advisor with them, but we've brought on a number of high quality exempt market dealers also, and seeing a lot of enthusiasm and excitement with them. So they've done their due diligence, and believe me, their due diligence is extensive. So they've done all that. They've given us the thumbs up and said, you know what, we like what we see. We have a lot of confidence in what you guys are doing. We're on board. We have no problem recommending this to our clients. And I'll sort of finish things off here real quick with our management team. And, this is so important. And, having that deep management bench that can not only plan, but execute. And that's what this team brings to the table. So Vaughn Koyeman is our founder. He started the company. Danny Friedman is his partner. They're co-owners in the company. They're the driving vision behind the company. Vaughn's out going across the country, looking at acquisitions. His 15 years of experience in the markets gives him a lot of off-market contacts and people to deal with. So he's been real busy out there looking at acquisitions. Danny, I get to work with him every day. And again, just a really driven guy, eats, breathes, and sleeps self-storage. And these gentlemen are in this for the long term. Like, they're not just looking to make a quick buck and exit. We'll probably look at rolling fund number 1 into fund number 2, because we see a long runway ahead. And then, of course, our executive management bench, Terry Thomas, our CEO. He's the gentleman that holds the glue to all these companies together. And he's a gentleman that can see around corners, see around curves, and he brings a tremendous amount of management and real estate acquisition experience from major brands like Coca-Cola, Hudson Bay. Meg Calhoun, our VP of Finance. I mean, again, just taking reams amount of financial data and turning into something that that we can make sense of and that we can plan and execute off of. Brian Banfield, our CFO, and again, wonderful amount of experience with Brookfield Asset Management, with large real estate acquisition deals. And again, he can take those long or big streams of financial data and turn it into graphs and things that really make sense. And for us simple people that don't have that depth of knowledge on the numbers, it really helps paint a great picture for us. And then our non-management board members, our council, our oversight. Joe Friedman, who happens to be the brother of Danny Friedman, he was vice chair, senior counsel at Brookfield Asset Management, also in charge of the private equity group responsible for strategic initiatives. But he brings tremendous counsel and oversight and guidance for us. And then Reed Carter, of course, Brookfield Asset Management. It seems that we kind of scoured a lot of great people from Brookfield, but you all know them. They're a huge real estate company. But Reed, lots of experience on boards and brings tremendous oversight and guidance for us also. All right, just want to sort of wrap up the Make Space Advantage again. Management experience and alignment. And it's very important, as you know, that the GP, the general partners, are aligned with their own capital in the fund. So Danny and Vaughn personally or they combined have $2 million into the fund themselves. All their senior management have substantial contributions into the fund. So it's in everybody's best interest to make this work as best as possible. And then the source of acquisitions. Like I say, we're not scouring the country and paying top dollar. We're finding the right properties for the right price, and we're developing, stabilizing, and bringing into the fund. As we talked about, self-storage, strong downside protection, recession resistant, and has really proven that self out in 2008, the great financial crisis, and in 2020, still continues to prove that out. And then cash flow, as you guys know, in commercial real estate, cash flow is king. And your investors want those dividends, and then you want something below the dividends too to put in your pocket. So having that cash flow, having those stabilized properties, being able to pay that out to our investors is something that's very important to them. Just real quick on exit options. I'm not going to go into this too much. We've had some interest already from some larger storage operators, want to buy us already, and we're just like, not yet. We'll talk down the road. Some talk about creating a REIT, a public vehicle, or just kind of going public. We've had some discussions around that. Once we get that $100 million mark, perhaps a sale to an institutional investor, a large hedge fund, and then a larger make space fund where we would give our current investors the opportunity for a liquidity event in 2025. If they want to cash out, that's great, that's fine. Yeah, but also the opportunity to perhaps continue on if they're happy with what's happening for their funds. So let me just recap the offer real quick. I hope I'm okay with my time. I don't want to go over and make sure that Ava has enough time too. But so we're targeting that 6% annual return, paid out quarterly, cash or DRIP, targeting that 12 to 15% or total target annual return on exit. And then, looking at midsummer 2025 of exiting the portfolio. And then we do have the opportunity, if market conditions warrant, for 2 12-month extensions. If investors are interested in going to the DRIP program, they can purchase the units at a 3% discount. Currently, we're in the A3 series, which is a 75-25 split in favor of the investor, and it has an 8% hurdle. So I think you guys kind of understand this already. So on sale, investors would receive back 100% of their capital. They would also receive 100% of the first 8% of profits, and then it's just a clean 75-25 split in favor of the investor after that. So a very clean waterfall there. The fund has a 1.5% annual management fee, and very attractive too that this fund is available for all your registered accounts. So I would invite you, if there is more questions or interest, reach out to myself or Lynn. I mean, I can't do the documents for you. Lynn's a person that can really give you all the insights from a regulatory standpoint and an investment standpoint of whether this may make sense for you. But listen, I want to thank you all very much for allowing me to spend some time with you today. And like I said, a great thrill for me to talk to real estate folk, because I know you guys get it. So Lynn, I'll bring it back to you, and thanks again.
Thanks, John. That was awesome. So yeah, lots of great information, and we have lots of new people on tonight. So some of these terms will be new to those of you. So don't worry if you didn't catch all of it. It's one of those things we call this information by fire hose. right? So when you're first starting down this path, you know, it's like, what did he just say? What language was he speaking? And as you attend more and more events, you're like, oh yeah, NOI, AUM, I know what those things mean. So they will become terms that you'll get familiar with. And so what I'm going to do is, so that we've got enough time for Ava, we're going to pretty much jump straight into Ava's presentation. So if you've got some questions, you know, just maybe make note, write them down. I've written down some comments, some things that I'm curious about. John, just quickly, what was the minimum investment through Raintree? Was it 25K?
No, it's actually $6,000.
It was okay. I thought maybe it was, but I didn't want to say for sure. So
Yeah.
you can actually get in with a really low amount, and you can get in with your RSPs and your TFSAs, which is fantastic. So great to be able to get those out of crappy 0.5% GICs and terms. Oh my goodness.
I like your thinking.
Yeah. Just and get, you know, just getting started with something small feels nice and safe. And you know, again, what I love about it, the team, right? We always talk about the team. I mean, look at the team that's put this together, look at the team that's behind it. The fact that Raintree's involved, the management team, the board of directors, like that's the kind of thing that you want to look for when you're making these kinds of investments, is the team. You don't need to know everything. You want to know that the team can answer your questions and that someone on the team knows what they need to know, right? That's the big thing, because we can't all know every single thing. So let's jump straight over to Ava, and then we will hop back and we can have a general discussion, because I'm sure there's going to be some things that will come up. So just quickly, Ava and I met, I guess it was just over a year ago.
It was.
Just before the, you know, the glory of the pandemic hit. Right?
It was all,
yeah. So Ava and I met. She came to a WREN event that I actually hosted when I was living in the Michael Bublé house on Government Street. And so Ava had just arrived back from Alberta. She's one of the youngest award-winning agents at RE/MAX. She's just been unstoppable. Can't wait to get to know, for you to get to know her more. She's going to be also writing a chapter in the book. So I'm really excited about that. She is the CEO of CPI Capital, an investment firm focused on acquiring, upgrading, and managing U.S. multi-family value add assets. So, you know, that value add, right? That's something that we're talking about a lot tonight. And she's ready to get this thing going. So she's got a great opportunity for us in Florida. And I'm going to turn it straight over to Ava. So let me just make sure that you have the screen sharing ability. I think you do, but let's just make sure.
Wonderful. I just want to say, John, great presentation. That was fantastic. Thank you so much for that.
And so, yeah, so Ava, take it away. You can share your screen and let's hear about what you've got going in Florida.
Wonderful.
Sunshine State.
I can't wait to share that with you. Maybe just before, Liza, maybe I could take maybe like just 4 or 5 minutes and just quickly let everybody know who I am. Because you know how, you know the saying, you invest in the project, but you're also investing in the person. So I know that I haven't really seen any of the faces here tonight. So just a little bit of a background about me and how CPI Capital gets started and why I'm so excited to share this opportunity with everybody. I've been a real estate agent for over a decade. I started in Alberta. I got this bright idea about 3 years ago to move. I did really well in Alberta because I grew up in a very small city of about 28,000 people. And it was really, I was top in my office and so forth. And I'm like, you know what, Mom and Dad, everybody's getting married here. Everybody's having kids. I'm a businesswoman. I'm going to move to the big city. That's my dream, to sell real estate in the big city, Vancouver. And everybody looked at me like I was crazy. And I packed as much fashion as I could in the back of my Mercedes, and I drove out to the big city, and I just felt like I was on top of the world. Little did I know when I got here, I was pretty much going to get eaten up and spit out by the realtors here in Vancouver. It is a shark eat shark world, and God did it ever build me as a businesswoman that I am today. So that's kind of my background. Now, when I started real estate here in Vancouver, and this is why I started CPI Capital, is I really noticed this massive pain point that people were facing. Everybody's taught to put their money into real estate. Everybody's, wants to put their money into real estate, diversify, and so forth. Well, when I sold real estate in Alberta, people would purchase very, very low cost to purchase real estate in Alberta. They get a little bit of cash flow, but not much appreciation. Now, here in Vancouver, you're only buying for appreciation. You're getting most of the times your negative cash flow. So I'd always have investors I was dealt with so many investors and they'd be kind of in chaos. Ava, where can I put my money? Well, first, good luck getting approved for a mortgage with the average house price in Vancouver. So essentially about 2 years ago, life works in mysterious ways. As I was going through all these changes, I met my business partner, August Beniaz. And him and I came across this we were watching YouTube one day and we got introduced to this apartment syndication on the other side of the border. And God, did we ever fall in love? We seen the opportunity that existed on the other side of the border. He was a developer for 15 years here. I was a realtor for a decade. We're like, wait a second, we've never seen these type of numbers here before in Canada. Why isn't anybody going across the border? And why aren't we seeing this more? Well, we realized the pain points, okay? There's the taxation issues. There's, when we start talking about these higher returns, these are obviously institutional quality size assets. How are people getting involved with those and so forth? So essentially we stopped our lives. I left real estate, he left development, and we've solely focused on building up CPI. And that is now where we pool together Canadian capital and we all purchase multifamily garden style apartment communities in the Sunbelt states in the US because the opportunity is so beautiful. So that's a little bit about myself. I'll go ahead and share my screen now and I'll share the opportunity that we have under contract. We're very excited about this. For fellow Canadians, with our corporate structure that we have in place, you are relieved from double taxation through a foreign tax credit. So we have all that set up in the back end. So as we're going through this and I start talking about income from the States, don't worry, we'll hold your hand through that process and make it very streamlined. And you are simply a passive investor who writes a check, sit backs, and reaps the benefits of cash flow and appreciation. So I'll just dive into here. Liza, we were kind of saying the Canadian dollar is at an all-time high. So this is an incredible time to invest in the US real estate, especially doing it passively with CPI Capital. I'm just going to start off with some disclaimers. All of the numbers, of course, that I mentioned on this presentation are forecasted. All the returns are forecasted. All investments are risky investments, so it is your job to do your due diligence, of course, with your lawyers, your accountants, to see if this is a suitable investment for you. And this opportunity is open for accredited investors only. And I'm just going to quickly touch, it'll take me 2 seconds, but an accredited investor is someone who has a net income of $200,000 per annum, or combined with their spouse of $300,000. Or the next option, it's one of these or the next, individuals who have at least 1 million in financial assets, so that's cash, securities, stocks and bonds, or individuals who have at least 5 million in net assets. Okay, so moving forward, I'd like to present to you the Ascend Waterley, which is located in Orlando, Florida. And I'm going to share some highlights of the property on why we're so excited about it. This asset is a 354 unit garden style apartment community, and it's located in a highly affluent wintergreen submarket of Orlando. So I'm going to kind of go through some points that will excite you along the way, but the submarket has shown tremendous job growth and population growth. And this is kind of what John was mentioning as well. These are very important key things that we got to keep our eye close to. Now, this area is rapidly growing with stellar demographics and is home to notable white-collar employers and medical jobs. So the Orlando MSA was one of the top investment markets prior to COVID-19 pandemic and is rapidly making its way back to the top with, like I said, strong job growth and overall population growth, and it's ranked number 3 in the country. So I'll go now, these pictures, okay, you look at these pictures and you'll notice that it's literally an absolute resort where people can call their home. So these garden style apartment communities are super popular in the States. There's lots of land, so these assets are spread out, and the developer is able to build, there's lots of room, they're 2 to 3 stories high with the most incredible amenities right outside your door. And this is what Americans love, okay? They love to rent these places. And I mean, who wouldn't love living here? I mean, we're all staring at this, probably drooling. So here we are. Now, CPI Capital, myself and my partner, August, we have partnered with a company in the US, our active operators, passiveinvesting.com. This is super important for our investors here in Canada to understand. We have scouted the best operators to partner with. They've gone through rigorous criteria that we've put them through. And passive investing, we've had a relationship with them for about 2 years now. So, you know, they opened their books to us, which was huge. I even contacted some of their investors, and we look at their performance. They're an all-around just phenomenal operators, and they happen to be our partners. So we're co-GP of the project. And I'll move to the next slide here. So this is an institutional investment, which usually means it's purchased by institutions or banks, if you will. But the exciting part is we're going to pool our capital together and be able to be, be able to be owners of this property. So that's a cool kind of exciting part of purchasing an institutional investment together. And I'll just go through some of these slides. So investment summary, it's this 354 unit asset it's a $92 million asset. Okay, it's a $32 million raise, and what we do is we hold the asset for about a 5-year hold time. So those are just some numbers that I want to note on. Depending on where the market's at, of course, we'll exit the asset a little sooner or a little bit later, but on average, it's about 5 years. And I'll just go through more of this. This is all about, I mean, this kind of looks like literally like a resort. A lot of our investors are asking if they can vacation here, but it's for the tenants only. I'm going to jump right into what's in it for the investors. So we have I don't know if you can see my mouse here, but we have a two-tiered equity structure, which allows you to be able to decide whether you want higher cash flows in the Class A, which is right here, at 9%. Then you have those higher cash flows and there's no participation in the upside, or you can be a Class B investor right here, where you see that there's a preferred return of 7%. And you'll see after the 7% achieved, there's a 70-30 split after that between the GP and the investors. Really important thing to note here is the GP doesn't make any profits until the investors make their pref return. In the Class A, you don't participate in the upside, so you have this 9% return every single year. So it's a little bit of a lower risk investment, but the Class A investors get paid first, and then the Class B investors get paid secondarily to the Class A. So for the limited partner Class A, it's going to be 100,000 USD. Everything's in USD dollars, minimum investment. And for the Class B shares, it's $25,000 USD to participate in there. Now I'll go here. This is a breakdown year by year. So I just want to give you guys some real expectations on what we feel we can achieve on this property. If you look here on the return summary, you're going to see the Class A is 9% per annum, right? So on $1 million investment, you'll expect $90,000 cash flow back in your pocket, distributed quarterly every single year. The Class A is the lower risk investment. Now, if you want to participate on the upside, and that's where we do the value add, and you get kind of a boatload of money on the back end, that's going to be your Class B. Now, so right here, and what we like to do is we like to do cap rate exit scenarios. And you'll see, I don't know if you can see my mouse or not. Perfect. So you'll see these cap rate exit scenarios. Now, we purchased this property at about a 4.03% cap rate. Now, the likelihood that we feel the cap rate is going to be below that, that's possible, especially with all the growth that's happening in this market. But my team is predicting that it's probably going to trade from a 4 to 4.5% cap rate. So that's these numbers right here. So you can see here the different scenarios will be basically, and we like to just kind of give an average for our investors, is a 13.7% to a 19.1% right here IRR with an equity multiply between the 1.8 to the 2.25 equity multiply, and the annualized going from 16% to the 21.5%. So there's definitely some great opportunities for the investors here. And I forgot to say, this presentation is usually done by me and 4 other guys. We got my other team. There's not only August, there's Dan Hanford, there's Danny, and there's Brandon, and we all kind of take portions. But you guys got me all just to myself today. So if there's any questions, please, by all means, I'll get you the answers to that. No problem. Now, one thing that is really important for me to point out here is that value add opportunity. Okay, so most people are like, Ava, this looks like a brand new property to me. Where the heck is the value add at? And how can there be value add? Now, this is really cool. So 350 out of the 354 units, we started opening up back in March of 2020. Even through the pandemic, they were able to get in 30 plus leases every month in this particular submarket in the Orlando, which is a lot, which is really exciting. So I wanted to kind of tell you a story about the lease up and why there is an actual value add opportunity that's part of this property, even though it's brand new and it's already built. So we're not talking about construction value add, we're not talking about renovation value add on a brand new build, but we are going to touch on a few areas that are going to be exciting and why it's value add. So you'll see here that the average market rent per square foot is $1.47 per square foot. And that's really important to note because we've done the numbers and that's way under market rent. So that's 15 to 18% under market rent, which is great for us because now we can go in there and they already have, right now they have the leases that are being renewed at over 10% on their original lease price. And the reason why this is because this is a merchant build. So the developer who built this, they build to sell, right? They don't build to rent the units. So they just got a bunch of people in there and at a very low rental rate. So that's where we're able to come in there and push the rents up, which is then going to create more cash flow for our investors. And that leaves us an opportunity to buy it. And of course, improve operational deficiencies. And the biggest part is increasing the rents to the current market rents over time as the leases are being renewed. So there's a lot of potential there. And then I'll just go to the next page here, the demographics. So the demographics in the Waterloo area are kind of a higher end demographic. You'll see here the average household income is 96,000, close to 100,000. Now the annual growth from 2010 to 2020. So like I said, population growth equals job growth and so forth. The annual growth within a 1 mile radius of the Ascend Waterloo was 22.5%. So most areas are seeing, the 10, 20, 30% in the whole entire, in the whole entire space. This is just within a 1 mile radius. So imagine the population growth, the job growth. We believe that we're going to exit this asset well over $100 million in 5 years. So there's a lot of appreciation that's going to be happening there. 39% of the population population has a bachelor's degree or higher within a 3-mile radius, and #1 best suburb to raise a family. So those are just some really cool stats that are important when diving in deep to why we love this property. And then, of course, this is just 290,000 total population in Orlando in 2020, and it's the 4th largest city in Florida. So these are some great numbers. Highly affluent and rapidly expanding suburban Orlando. And I love to go to in the heart of Horizon West. So there's tons going on here. This is a kind of a fun one to show. The Ascend Waterley is located right here. And you'll see right here is Highway 429. And just up the road here is Walt Disney World. So it's literally right there. That was my favorite place as a kid. I got to go one time in my life, but and right over here, you'll see that this is all development happening. And the same developer who developed this 354 units is developing a beautiful subdivision right here. My partners were telling me it's going to have a beautiful waterfall that the asset looks on, but it's really like the high-end area of Orlando. So if you tell anyone from Orlando that you're going to be in Windermere, they right away know that it's definitely the higher end. And this is just the Ascend again right here. It kind of shows you how busy it is around this area and how much potential there is for all the growth. Property profile, Ascend Waterley. This is just the unit mix. There's 14% 3-bedroom, 42% 2-bedroom, and 44% 1-bedroom. The amenities. This is the most beautiful amenities. Okay, there's the best in class luxury amenities. The clubhouse, you have your fitness center with a yoga room, heated saltwater pool with lounge chairs and cabanas, outdoor gatherings with TVs and ping pong, an outdoor playground, and a beach volleyball court. So you can literally wake up and the sky's the limit. These are the property details. Everything it's just granite, obviously beautiful appliances and so forth. As you can see here, there's 7 different floor plans to choose from. So that's a little bit about that. And then the financial analysis. This again is the offering summary that I already kind of went over with a beautiful picture on the side here. And these are all actual pictures of the property. So just letting you guys know, this is actually the beautiful property that people will be, the projected, the performa projection. So of course the T12s, we get a copy of that. We look through all the numbers, and you can see the numbers going up and up as the years go on because of the push for the rents and the value add there that exists. There's the rent comps, and I don't want to take up too much time here, but the sales comps are here as well. We put all these nitty-gritty numbers in here for people to kind of dive deep. So Orlando by the numbers, #1 travel destination in the US, 75 million visitors in 2018, and the list kind of goes on here. Orlando, Florida, once again, the economy, the population, this just really dives deep into why we love it so much and how much growth there is. Disney World, Orlando has the largest employers, of course, Disney World. Walt Disney World, I should say. They have also the Universal Orlando, the Advent Health, Orlando Health, and of course the list goes on right here on the right-hand side. And these are projects underway. So they're like, lots of development happening. And then I'll just go here. So now when anybody is looking to invest with somebody, it's always important to look at their track record. This is really important because you're going to be putting money in with somebody, and you want to make sure that they've done this before. So our operators on the other side of the border, passiveinvesting.com, they have about $500 million worth of assets, and they have very, very happy investors. So this is their portfolio, and you can kind of see here the different assets that they've done already and have had very happy investors. And we're very excited to be partnered with them. And as I say, we are, and more pictures of the asset. And as I say, we're kind of coming in as the 51st state, if you will, with our Canadian pooled capital. And they have, so this is the property management company. It's called the Full Service Property Management. They actually already own an asset that's really close to the Ascend, and they have this exact same property management company that they work with already. So this is who's going to be taking over the new one. This is August Beniaz and myself and passive investing, and this is the whole team put together in one, and that's my presentation, Liza. Thank you so much.
That's awesome.
Thank
Very
you.
cool. Business trip to Orlando, anyone?
Yes, we got to go check out the amenities and
Yeah,
feel the
exactly.
property.
Yeah, great looking property. I made a couple of notes, right? It's a couple of things that people may forget is that the US has really been in a housing crisis in terms of having enough supply since 2008, 2009, since the last global financial crisis. They have not kept up to the needs of housing. And so the fact that this is already built is great. And if you kind of look at the other side of that, because of all of the increases due to the pandemic and the shortages and supply issues, anybody who's trying to build right now is going to be facing an increase in costs. So anybody who starts building tomorrow is going to be paying way more likely to build than these guys did when they built it a few years ago. So it kind of hits that sweet spot. It's new, it's already done, it's in the US, it's in a growing area. There is a housing, people always forget there is a housing crisis in the US. It's one of the reasons why we love the mobile home park so much, because if you look at a housing crisis and you look at what are people going to do in a housing crisis? They're going to sell the property they own, or in a global crisis, they're going to sell the property they own, they're going to cash out, or they're going to go bankrupt, or they're going to scale down. And, the whole mobile home park thing, we always love, because it's like, well, you got to go somewhere, right? So
Everybody needs a place to live.
everybody needs a place, right? So and Ava, these are rentals, right?
Yes, yes,
So yeah, so rentals, less millennials are buying, more millennials are moving to places like Florida because of the tech industry, the job market. So really, really interesting. It's beautiful. It looks like the BFF mansion. Like it looks like the best friends forever mansion that we're all going to buy, and it's our, it's going to be our own retirement home, right? So
100%. And by the way, there's like this massive interstate migration happening right now from California and New York, and everybody's flocking. So it's just, that's where the population and the job growth just goes wild. And like I said before, this asset class was the best performing asset class during COVID. The government steps in when people can't pay their rent, as shown.
very cool. Awesome.
Yeah,
okay,
so much for the opportunity, Liza.
Oh yeah, my pleasure. So it's 8:05. So as I say, we usually go till about 8:30. So now we can just kind of ask some questions. So if anybody has any questions of John with Make Space, or if anybody has any questions of Ava, or if you have some general questions, I know there were a lot of, again, I mentioned there are some new people. So there's probably some things that maybe you haven't heard us talk about before. And I'm happy to, get on a call with some of the new people and explain some of the terminology. And also, in terms of talking to Lynn with Raintree, if you invest into Make Space through Lynn, through the exempt market offering, Lynn does a very thorough kind of assessment to make sure that you understand exactly what you're getting into, that you're comfortable, that you are, that you are going to be comfortable in that investment space. So it's, yeah, pretty cool. So question from Judy, what's the minimum investment again? So it was $100,000 for the class.
Oh, is that for me? 100,000 for class A, and that's at the 9% preferred across the board.
Yep.
And then 25,000 USD, of course, for both for class B.
Okay, so you can actually get in with 25,000 US.
And then I will mention as well, every single one of our investors, including my own family members, they are serviced through my exempt market dealer as well, where all the legal documentation and everything gets put in our investor portal, which happens to be our exempt market dealer's investor portal. So all that fun stuff, you have to make sure that your accreditation is on point and everything else too. So
it's not easy, right?
Once you
So
get past all that stuff, it's super easy. You write a check, you sit back, you relax.
yeah. So and so one of the, you know, one of the reasons for that, and I'm sure that a lot of you have started seeing those commercials, right? There are so many real estate scams out in the world, and there are so many ways that you can lose money in real estate. So, you know, having the accreditation, having it go through an exempt market dealer, having offering memorandums, having the team behind it, all of these are the types of things that give you confidence and that show that these projects have been vetted and they've been checked and the due diligence has been done and the lawyers have crossed the T's and dotted the I's. And so that's where, you know, sometimes up front these seem a little bit more complicated, but when you start getting into these types of investments, they're passive investments, right? You're not picking up a hammer. You don't have to come and help me build a shed and babysit the goats up at Souk and help me figure out how to put a sewer in or a septic tank, right? Like, you know, I mean, I'm up there walking around with logs on my shoulder, you know, like we're clearing the land one log at a time. So it's a much, much, much different type of investment.
Awesome, people are like, hey, I want to invest with Ava and John today, please.
Don't make me carry logs, please, Liza.
It sounds fun though. It does. It really does.
Yeah, feed goats, right?
Yeah, I love it. You can do it. The best part is you can do a little bit of both. Diversification is everything.
Exactly. Do a little bit of both. Exactly. So I'll just pop into the chat, and there's only a few of us on. So if you want to unmute, yeah, just unmute and just ask your question. Feel free. Buildings did not appear to have elevators. It might just be that you didn't get a picture of the elevator. So there are elevators in the,
yeah. We should, you know what, you'd be, eventually when the doors open, we definitely want to like take our investors down to the actual
tour.
People want to see things in person, right? Or so forth, but
yeah. So yes, there are elevators. It's just the pictures didn't show it. Can't be in Florida without elevators, ma'am. There's no way.
I love it.
And Robert had a question about hurricanes and such, and I was mentioning that it's Orlando, so generally they're out of the path of hurricanes. I mean, they do get a few other wild weather things down there, but all of that's, you know, part of the, you know, the insurance coverage that the company has, the organization has. So those kinds of things are generally thought about and looked after in that big process. Cool. All right.
Any questions from anybody?
Any other questions about either of these investments or about anything else in general? Sabrina, I don't know if you want to take a minute and share your a little bit about your triplex, or do you want to wait until you've got some more info?
I would like to wait till I get a bit more info. Yeah.
So I'm excited about the triplexes. So I will encourage Sabrina to. She's running some numbers and putting a little bit of a package together. So we'll make sure that when she's got that, so you know, you can buy property in Montreal for under $700,000, right? Multifamily under 700,000. Go ahead, Robert.
Hi, nice to meet you all, and thanks for the presentations. Quick question in general for investing in the U.S. properties. Are there any taxation issues, U.S. taxation issues? And secondly, what about currency risk in terms of if the U.S. dollar goes up or down, what happens to the investment return, or is that hedged in any way?
Yeah, good question. So all of the investments is made in USD and returned in USD. And as far as the taxation, so through our corporate structure that we have created through a web of corporations and limited partnerships, when we flow the money into the US, when it comes back, our investors are relieved from double taxation. So usually what happens, we form a limited partnership here in Canada. I'm the GP, our investors are the LPs. As one entity, we go into the project on the other side of the border. When the money flows back, a K1 form is produced, and all of our investors get a sub K1 form. And then they're given something called a T5013 slip. And this is a slip that you give to your Canadian accountant. They do an intricate calculation, and then you're relieved from almost dollar for dollar on double taxation. We work with Smith Accounting, and our lawyers are Ferris LLP. So by all means, I can set you up with my accountant to ask any any hard questions, but essentially that's how it works. There's a foreign tax credit. There's a tax treaty that exists between Canada and the US. My parents are both accountants, and trust me, when I told them that I was getting into the US, they're like, what the heck are you talking about? There's double taxation. And we have talked to, gosh, 40 to 50 lawyers and cross-border tax accountants and learned the ins and the outs of this whole entire system. And we have our corporate structure set up to where we're going to hold your hand through the whole process.
And just to add to that, you know, the cool thing is we do have a good tax treaty with the US to avoid that whole double taxation. So, you know, again, Dave Putin often refers to that when we talked about the whole mobile home park thing. Filing a US tax return when you do have to file as a corporate owner is usually between $400 and $500. So, you know, depending on how the structure is, you with some investments, you have to file a US tax return. But yeah, there's, I mean, again, you know, Ava's background, and then our friends with Real File, Dave Putin, and he's a cross-border accountant as well. So he has an accounting office in Canada and in the US, and he is a former CRA investigator. So
nice.
You want those kinds of people on your team, right? People who used to investigate for Canada Revenue Agency. It's like, yeah, those are the kind of people you want to run these questions by. So yeah, good one, Robert. Nice. Any other questions?
And I was going to say, a lot of these opportunities, you know, it's funny. We've talked to so many syndicators. They're knowing us. They literally know us as the 51st state over here now. It's really cute. But a lot of them don't want to accept the Canadians into their deals, like right directly, because of all these issues that have happened. And I know some Canadians that have invested. They formed an LLC and on the other side of the border, and then they didn't do it properly, and they were at a very high tax bracket. And at that point, it's not worth the investment. So it's really important to do your homework on that and make sure that you have the right people holding your hand.
Yeah. And on that note too, I mean, that was one of the issues that we ran into when we were looking at mobile home parks, right? The US loves to have Canadian investors, but it's not worth it if you're doing something that's under $1 million. So if you're buying, you know, we were looking at a couple of parks that were, you know, awesome little parks for $1 million too, and we wouldn't have needed a loan for less than $1 million, and or we would have needed a loan that ended up being less than $1 million, and it just wasn't worth it. They just don't want to do the paperwork, so they will happily do the paperwork if it's a substantial amount, but they just don't want to do the paperwork if it's a small amount. So this is definitely you know, the way to go for investing in the US. And Robert, I know on the currency question, right now with currency being high, right? I mean, you're able to buy US dollars so cheap. So it's a good time to get in. And so if you have US money, or if you're buying US money, you know, I borrowed US money a while ago and took a hit on the conversion when I had to pay it back a little bit. It's like, damn it, I should have borrowed it in Canadian. You know? Now, you know, different story. So I'll be sending some more of that back. So good time to buy the US dollar and be investing in the US because it's in our favor right now. So very cool. Any other questions?
I just wanted to quickly let everybody know that because it's so much information kind of packed into one, August and I have a YouTube channel, an educational YouTube channel that we bring on experts. So our partners come on, lawyers come on, you know, we bring on everybody that would be kind of bring value to our listeners. So if you wanted to learn more, you can check out Canadian Passive Investing on YouTube. And by all means, just reach out to me anytime. There's a lot of information at once. So I know it took my parents about 15 times kind of explaining to them how everything works, but people get really excited once they really understand how everything works. Yeah. They're like, cash flow and appreciation, this sounds great. So definitely.
Yeah, and it is information.
Education is key. Education.
And it is information by fire hose, right? So it's like sometimes sometimes it's just gonna go like this, and you're gonna go, somebody pour me a drink, you know. And other times it's, you know, you're going to be like, oh my gosh, I understand all of that. So yeah, we've got a wide range of people who, you know, people who are just getting started and some super sophisticated, savvy investors. So on that note, we've got a couple of questions. John, can you give us some explanations for some of our newer folks? And A3 tranches and hurdles.
I know a lot of crazy words. Huh?
Yeah.
Ava, by the way, a great presentation. I love that. And I know of Dan too. I've seen his work in the past too. So.
Oh, have you, Dan Hanford?
Yeah, I don't know him. I know of him and his work.
Oh, very cool.
Yeah.
Very cool.
Yeah,
Very cool.
yeah. Very, very professional. Love it.
Thank you.
Okay, so A3 is simply, I know it's a big word, but it just means that this is a series that we're raising money in right now. So when we started the fund, it was like A1, A2, A3, and then A4. So we filled up the A1, which was a certain amount of money, and then the A2 was a certain amount of money. And then we're in the A3 right now, which is essentially $10 million. And once we raise $10 million through our A3, we'll switch to A4. And they have slightly different splits based on, you know, early investors are generally rewarded a little more for coming in early. But still the A3, a very, very favorable split with our investors. But that's simply what it means. Just that's the series we're in right now. Hurdle rate simply means that we don't get paid until you're compensated for the first 8% of returns. So if you invested $100,000, you would get your $100,000 back, and then you would get 100% of the 8% on your money there. So another $8,000 there goes to you. And then once you're paid out that $108,000, then there's a 75-25 split in favor of you, the investor, after that. So the manager doesn't get paid until you're looked after. That's simply what it means. Was there one other one, Liza? One other question?
Oh, tranche.
Tranche, yes, yes. So that's the same thing. A tranche is simply an amount of money, you know. So the A3 tranche is $10 million. So that's all that tranche means. I hope that clarifies it for you.
Yeah, it's just fancier terms, right? Phases and you know, instead of saying buckets of money, we say tranches of money.
The tranche, yeah.
So it's, you know, we talked a lot about that with our Esquimalt property, right? We had people who came in early for the first tranche, and then we finished that, and then we went and we just did the capital raise. We finished for the second tranche. So it's kind of like you're filling up one bucket and that's done, and then you move on to the next bucket. So
that's it.
That's it. Buckets of money. Doesn't everybody just want buckets of money?
Yes.
Keep them coming.
Cool.
Great question. Thank you.
Awesome. Great. So it looks like I think we've got most of the questions. I'll just scan through once more. If anybody wants to unmute though, please feel free. But yeah, great presentations. You know, it's exciting to be, you know, talking about investing in the US again and talking about storage, right? I mean, both of these things are great opportunities. Like I personally, like for me, storage and mobile home parks and investing in the US are my three favorite things. So, and of course, goats. Now, you know, now that I'm a goat herder, right?
I have to say, I absolutely love your energy. You always have the best energy in the world. Thank you for, you know, building this club and we love you.
Oh, thanks. Thank you. It's very sweet. Yeah, we like to have fun, and I can't wait until we can have fun and wine together. So yeah, so, you know, just some closing notes, right? So a couple things that both of you touched on. Again, the team. It all comes down to the team. If people aren't transparent, if they're not going to tell you who their team are, if they're not going to offer to put you in touch with their lawyers or their accountants or their team, just run in the other direction, right? You're investing, like Ava said, you're investing in the people. The building is a byproduct, you know, the storage units are a byproduct of all the hard work that these people have put together. And it's the relationships, you know, again, Ava and I were talking a couple of days ago, you know, and I was saying that it takes a while for people to start investing because they don't know who you are yet, right? So, you know, like Rosie is maybe seeing you for the first time, right? Whereas Rosie's seen Sherry and Joan, I don't know how many times now, probably 50. So, you know, we've all seen Lynn lots of times. We see Darlene a lot. So as you come onto these calls, participate, get to know each other, you know, one day one of you is going to have an opportunity that you want the other people to be aware of. And so the more you're here, the more you're developing those relationships. And then, you know, when it's time to pull the trigger on something, then you've got people that you can turn to. So again, that team thing, I really just wanted to reiterate. The immigration stuff, right? Like, I mean, the housing crisis in the US and the immigration to Canada. I mean, we all talk about the economic fundamentals. So when you're making these investments, what are you looking at? You're looking at job growth. You're looking at, you know, what is coming into that particular geographic market that you want to pay attention to. Are there hospitals being built? You know, in the US, is there a Walmart supercenter there? Walmart does more research before it goes into a market than any other organization on the planet. So if there's a Walmart supercenter, you can bet that they have done the economic fundamental research, and you can bet that that's a growing market. If they've closed a Walmart supercenter recently in the area, that's something to have a look at, right? Doesn't mean that it's, you know, a bad area, but it's like, why did Walmart close that, right? Because they do so much research. You know, storage units, right? Like, again, for those of you who've been on a couple of the recent calls, we've talked about immigration. I mentioned, we talked about the upsizing, right? People aren't necessarily downsizing, they're upsizing. So people are they're moving their home offices. They're moving into those multi-generational, multi-family homes. People are like all living together, but they're not necessarily getting rid of all of their stuff, right? So if a family of 5 has decided that they're all going to have a family home together, they're still going to put their stuff in storage to kind of keep it in case things don't quite go to plan. So storage is always going to be one of those things that people need, whether you're upsizing, downsizing, right sizing, left sizing, or buying goats and need to store hay or whatever the hell goats eat. There's going to be a lot of goat jokes from now on. Okay?
For the goats, I love it.
Georgina, I can see you laughing. So it's, yeah, there's going to be a lot of goat jokes. I mean,
anything to do with farming, Liza, I'm in.
I know, right? It's just like, yeah, I've suddenly become a farmer. Like, if you'd asked me 3 months ago if I was going to become a 145 acre property owner with a farm, and we bought a grape crusher last week as well, so there's wine in our future. Of course we did.
And where is this Eliza, where is this property?
It's in Souk, so it's about an hour north of Victoria.
Amazing.
Yeah, beautiful. It's crazy, crazy property. Yeah.
That's priceless, Liza. Thank you. Thank you.
You're welcome. You're welcome. So it's 8:30. We usually, as I say, we wrap up about 8:30. Anybody got any last thoughts?
Liza, I did know that Robert had one question about why the 5-year hold period for private investments. And I'll sort of give my take, and Ava, if you want to give your take, that's fine. But essentially, a lot of investors are looking for a liquidity event. They want to get in, they want to get some cash flow, they'd like to get a payoff at the end of the day. And 5 years seems to be kind of the average time that in real estate, you can sort of take that property, do the value add, as Ava was saying, and get some stuff happening and give investors the opportunity for an exit. I know some are 7 years, 10 years. Ava, do you have any thoughts on that?
You know what? You couldn't have said it better. 5 years is that sweet spot where investors can kind of exit, get their money back and move on.
Yeah, exactly.
Yeah.
Thanks, Robert.
Excellent.
Thanks,
Cool.
Robert.
Good question, Robert.
Good job, Robert.
All right. Okay. So I think unless anybody's got any last minute comments, that was great. Like, awesome to hear 2 really exciting opportunities with potential double-digit returns, right? And ability to get in with a reasonable amount of money and backed by great private equity and exempt market dealers. So super to have that. Awesome.
Passive investing. Woohoo!
Yeah, passive investing. We love it.
Right.
Yeah. Yes, absolutely.
I like to invest in your goats, Liza.
Yes.
Yeah.
Yes. Well, there are people who are becoming goat boarders. So they're buying goats, they will help us, you know, eat the property because they have like 6 acres of trees that they have to eat through, and paying for boarding. So yes, you can invest in a goat, Robert.
Okay. 5 years, 5 years.
5 years, yeah.
5-year term.
Good cash
What are you
flow.
going to do with it at the end of 5 years, Robert?
Barbecue at your super.
Oh no.
Oh,
Liza, you created something new here, okay?
I know, right? Yeah, it's all going downhill from
you
here.
could do goat yoga. You could
Yep.
do YouTube videos. You could do lots of things with them.
So much coming. I know there's so much coming. So lots of fun. Great presentations. Thanks for being here, everybody. We'll have this recorded. We'll probably edit a couple things out. Maybe.
Why?
Maybe not. And we'll give everybody a chance to contact Ava or John or Lynn, and then we'll put it out to the wider group to see if anybody else wants to get in. And hopefully we'll see you next week. And then if you can pop into that poll, or just let me know via email if you're interested in our overseas, you know, the BFF mansion, or buying some property that we can pool together and have as a vacation rental in Portugal, Mexico, or Costa Rica, or Spain, or wherever. So we've got some great guest speakers that we're lining up for that, because I know everybody's just itching to get overseas. Oh my God, I can't wait to get on a plane. I cried watching a concert on television last night because I was just like missing live music so much.
Oh,
So
yeah.
I'm just like, oh my God, when I go to a concert, I'm going to bawl. I'm just going to be like,
So
oh,
happy.
sing some more.
Yes,
It's
yes.
going to be crazy. So yeah. All right, everybody, have a great night. Thank you.